The cost of long-term debt is the cost of capital from corporate bonds, which is also considered the rate that is required by investors in the market that buy those bonds. Now, a couple of definitions that we should look at first. Now, first is what we call the net proceeds, and that is the amount that the company actually receives from issuing the bonds. And those net proceeds are really net of what are called flotation costs. So those are the costs of issuing and selling the bonds, basically costs or payments to the investment bankers that put the issue together. And flotation costs are actually applicable to all types of securities, not just bonds, but also preferred stock and common stock as well. For bonds, the cost of debt is really equal to the yield to maturity, so essentially the I in the calculator that we solve time value of money problems with. And so what we'll do, very similar to any other time value of money problems, we'll have a present value, which is the cash inflow received by the company, essentially from the investor who bought the bond. We'll have a payment, which is the interest paid annually or semi-annually, whatever the term is, that's paid by the company to the investor that bought the bond. And we'll also have a future value, which is the value paid at maturity, the par value paid at maturity. And finally, what we'll do is we will compute for the yield to maturity, or I, in the calculator. The textbook does also have an approximation formula that can be used to, as it states, to approximate what the yield to maturity will be without having to plug information into the calculator. And you may do that for some problems here and there, but primarily what we'll use is the financial calculator to solve these types of problems. But the approximation formula is included in Formula 9.1 in Chapter 9 of the textbook. Now at this point, let's take a look at an example of how we would calculate the yield to maturity for a long-term debt or cost of capital, essentially, for the long-term debt. So in this example, let's assume that we have an issue where the par value is equal to $1,000. We have a coupon interest rate at 8%, a corporate tax rate of 25%. We have cost equal to $890, which is basically the cost or present value of the bonds net of the flotation costs. And we have years to maturity of the bond equal to 10 years. So the way that we would set this up in the calculator is we would simply type in our normal inputs into the calculator, which are given to us in this particular example. So we would have a future value, which is our par value, equal to $1,000. And I'll talk about the plus and minus signs here in just a moment. We'll have annual payments, in this case, equal to $80. We have a present value of $890. And we have finally our n, or number of years, equal to 10. And what we're going to compute for is I in order to find the yield to maturity. So we're computing for I. Now, when we plug these numbers into the calculator, what we're going to get as a result is 9.77. So you can run that in your calculator or your online calculator and make sure you're getting that same result, so 9.77. Now, when it comes to the plus and minus signs in class, what we typically have you do, or what I've recommended, is just always put the minus sign on the present value figure. So recall again that your financial calculator is going to give you an error message if you don't have at least one of the numbers, present value or future value, input as a negative number. And again, this is when you are given numbers for future value and present value. If you're only given one of the numbers, it doesn't really matter. But in a problem like this, where you have both a present value and a future value, and certainly also a payment, one of these numbers at least is going to need to be a negative. So in typical time value of money problems, what I usually recommend is, think about money out of your pocket to invest into a bond. This would be a negative. The present value would be a negative because it's, again, theoretically money out of your pocket, whereas future value we input as a positive number because that's money coming back to you at the end of the time frame or the maturity. Now, in this case, you have to think of a problem in terms of the company. So put yourself in the position of the company. So you're a company that's issued a bond, and what you've received from the issue is $890. So that's a positive cash inflow to you. Whereas when you make your annual payments, that's an expense. So that's a negative because that's money out of the company to pay the investor the interest for the year. And then likewise with the par value at maturity, that's money out of the company, $1,000 in this example, to pay the proceeds of the bond back. So this is actually the proper way to input it into the calculator to get the correct answer. You could have just entered negative as the present value and payment and future value as positive numbers, and you'll get the same answer. But I input it this way, or putting it this way in the video so that you could see technically the proper way to enter it based on the position or from the company's standpoint. Now recall that interest paid on bonds are actually or is actually tax deductible to the company that paid the interest. So what we've calculated here in this example is really the before tax cost of the debt. So the 9.77 is the before tax cost of the debt. And what we want to do to actually determine what the final cost of capital is from corporate bonds is really compute the after-tax cost of debt. So the after-tax cost of debt, again, is the interest paid on the bonds, factoring in the tax deductibility of those interest payments to the company. So in order to do that, what we do is simply utilize the tax rate. In this case, it was given to us as 25%. And we want to calculate the after-tax rate. And to do that, what we'll do is just simply take this is the rate of corporate bonds after tax, and that's going to be equal to the rate of the bonds before tax times 1 minus the tax rate. So 1 minus t, where t is equal to the tax rate. So in this case, what we're going to have is the after-tax rate is going to equal the before-tax rate of 9.77 in this case, times 1 minus 0.25, or you could have just put 0.75 if you just do the math in your head real quick. So when we do the final calculation, what we're going to have is a after-tax rate of 7.33%. And this is what we would actually use as the cost of long-term debt for applying to our weighted average cost of capital